Hello and Happy New Year. My name's Alex Brandreth, Chief Investment Officer at Lunar Investment Management. Welcome to the latest quarterly update. Now, it's certainly been another interesting quarter in the end of 2024, with Donald Trump being elected to the White House. We've had a UK budget, and politics in Europe have been very volatile, and both in France and Germany. So we'll be talking through that today. We'll also be looking back at what happened through 2024, which was a pretty decent year for investment markets. So let me just share my screen and we can go through the slides. Here we go. So we'll start with the bond market and we'll look at what happened to bond markets in 2024. We've got gilts, which is that blue line there. You've got corporate bonds, which is the maroon line. You've got emerging market bonds, which is the green line, and strategic bonds in yellow, which are more flexible bond portfolio funds. As you can see, everything was going smoothly up until September. And from September, you can see there that the blue line really then started to fall away. That's government bonds really starting to come under pressure. Corporate bonds similarly came under a little bit of pressure towards from September onwards, but emerging market bonds and strategic bonds held up pretty firm. The reason why government bonds in the UK and globally actually were weaker from September was there a number of reasons. One was the higher than expected inflation. Two, economic growth has been pretty robust globally. Maybe not so much in the UK, but it has been globally, and UK government bonds price off all other government bonds globally. And on top of that, there was also the run up to the US election. A lot of Donald Trump's policies are expected to be pro-growth, which is also going to be pro-inflation. And there's an expectation within the market now that interest rates maybe might not be cut as much as expected in 2025. What about equity markets then? Well, the good news is that most major equity markets we have on the screen here delivered positive returns in 2024. In fact, it was a stellar year for certain markets. You can see that the S&P 500, the dark blue line there, was up over 27% in the year. Similar for the NASDAQ, the technology index based in the US, was up nearly 28%. The heart monitor, as we like to call it, is the purple line there, which is China, the Hang Seng market, the Hong Kong stock market. You can see that it was languishing until September and then got an almighty boost when Chinese stimulus was announced. You can see, though, that did start to wane towards the end of the year, and Chinese markets were negatively impacted by the announcement of the Donald Trump presidency. Europe had a bit of a disappointing year. Europe has had pretty lackluster growth, and as we touched on, politics have been catching the headlines in both France and Germany throughout the year, and that certainly had an impact on sentiment on European equities. In terms of our home market, the FTSE All-Share, not a bad return, 9.5% during the year, the maroon line, but pretty much in line with Japan. Japan just slightly pipping the UK towards the end of the year. Now, I think there's an important point to mention here, and that is the re-election of Donald Trump, and that has been seen as a positive from US markets and the US dollar. And there's a few reasons for that. The first is the potential cuts to corporation tax. That will mean that overnight US companies are more profitable, which is a good result for shareholders. The cutting of red tape has been welcomed in the banking sector. The banking sector in particular had a very strong end to the quarter, as well as a number of other assets have performed very strongly after the Trump presidency was announced. However, there are complications, as we know, that could come down the line. Now, what about this year then? So this chart on the left-hand side looks at economic growth in 2023, 2024 in maroon, and 2025 in blue. And you can see the different countries there and what economic growth is going to be. UK and Europe on the left-hand side look very similar, economic growth of around 1%. And as we've entered this year, I think that's probably a fair reflection for the UK. There's a lot of talk about the budget having a negative impact on the UK economy. And that's certainly coming through at the moment. You're seeing unemployment starting to pick up, job vacancies are starting to fall because of the changes to minimum wage and national insurance. So it is really having an impact on the UK economy at the moment. But a lot of the policies by Rachel Reeves announced in the budget will also be pro-growth, and it does seem to be a little bit of a transition going from the private sector to the public sector at the moment, and the public sector will see growth. It's the private sector that's going through a bit of a tougher time. Europe still looks pretty challenged. Manufacturing particularly is being impacted in Germany, and Germany being the largest economy really drive what's going on there. Japan, again, similar growth to what's going on with the UK and Europe expected this year. I would probably revise the blue bar up for the US. Trump's came out and talked about 3% economic growth annually for the US, which sounds a lot, but it is really what the US does in average boom times, and that's what it's looking to achieve this year. So I wouldn't be surprised if that figure is revised up. And then finally, you can see that China continues to slow. China is moving from being a construction-based economy to a service-led economy, and service-led economies do grow slower. Now, on the right-hand side, the data gives you a good idea of what's going on right now. This looks at purchasing manager indices. We've got the US in grey, Europe in purple, and the UK in blue. And you can see this chart goes back to 2010, but if you look right at the end of that chart, you can see that that blue line started to dip down. The purple line, Europe, is basically starting to contract, which means it's below 50. So it is suggesting that right now, Europe and the UK are starting to slow. Whereas the data for the US is holding up pretty strong. And that's why a lot of investors are expecting that interest rates might not fall as quickly in the US. I think it's more difficult for the Bank of England, and we'll touch on that in a second. Now, we thought we'd put the man himself on. Don't worry, I'm not going to dance. And you can see here that we've also managed to get Trump to hit the Chinese bars here, which has been tactically done by my colleague. And we've done this on purpose because we've talked about the positives of Trump so far, but we haven't talked about a lot of uncertainties and volatility that might come. The first being tariffs. There has been muted tariffs being announced from January already. So far, it's been mentioned about 10% on Mexico and Canada, with an extra 25% on China on top. Nothing on Europe at the moment, but who knows? But that does create volatility and uncertainty. And as we go into this year, one of the biggest risks that we can see is further geopolitical issues. We've touched on the UK already. This on the left-hand side just breaks down where the different components of GDP come from. You've got consumption, government investment, exports, and the change in inventories. And as I mentioned earlier, the UK economy has really stalled. You saw basically 0% growth in the third quarter and a negative number in September for the month of September. And on the right-hand side, you can see that those purchase manager indices that I mentioned earlier, this time split out by manufacturing and services. Manufacturing and services have really had been hit since the budget was announced. The budget has really had a short-term negative. It had a negative in September before the announcement because people were putting off decisions, and it's had a negative afterwards because of the impact it's going to have. And I do think that the budget's going to be inflationary. The increase to national insurance, you had Next report this week saying we're going to have to pass this on in higher prices. And you're going to see that from a lot of firms because they're going to try and maintain margins, maintain profitability. And one of the only ways to do that is to increase prices. Now, the good news is we're not going back to the levels that we got to in inflation in 2022. This chart just shows the breakdown of the different components of inflation. And inflation at the end of the year did start to pick up. So CPI, Consumer Price Index, is now at 2.6% in the UK. You can see the majority of that is being driven by that core services, that blue bar, as wages have been increased. Maybe you might not see wages increase at the same rate going forward as inflation is at a lower rate. So there is some hope there. But we are seeing that those negative areas which are below the line here, which is liquid fuels and electricity and gas, well, they were big deflationary factors in bringing down inflation last year, but they are going to start to contribute as energy bills are starting to go up and the oil price is slightly higher. So you are going to see inflation to be a bit stickier. And that does cause a little bit of a headache for the Bank of England, because you're in a situation where you want to keep inflation down at your 2% target, but you also want to maintain economic growth. And it's a bit of a balancing act for the Bank of England in terms of what do they concentrate on. You can see here, going back to 2002, we were in that normal range, which we're going to refer to as the normal range of kind of 3.5% to 6%. We then had a period for 15 years of interest rates basically being at zero. And you can see the implications of the high inflation environment that we had through 2022 when interest rates were increased in every Bank of England meeting. We've since had two cuts. So we had the first cut in August. We had the second cut in November. It's forecast that we will have 2 to 3 interest rate cuts this year. I think that's probably in line with what our view is as well, and that's probably appropriate. And we do see that the long-term interest rate within the UK is going to be around 3.5%. And that's important because other asset classes, all asset classes, in effect, are priced off interest rates. We already saw what happened in bond markets in 2022 when interest rates were increased at such a rapid rate. And it also had a big impact on equity markets as well. So we do think interest rates will start to come down, which should be another positive for homeowners as well. So just in summary, economic growth this year is forecast to be mediocre. I think we've still got the hangover that we're dealing with from the UK budget, which is coming through. US growth should continue to accelerate. Hopefully you'll start to see some political resolution in Europe in the first half of this year, which can provide some stability to markets. But from an investment perspective, we're pretty positive. We're looking at bond markets giving attractive returns, and we are still in a falling interest rate environment, and that should give a nice tailwind for bond investors as well. Equity markets, there are pockets of the market that are a little bit expensive, but across the board, we feel that equity markets are quite supportive of these levels. So we're pretty optimistic as we enter 2025. Just wanted to wish you all the best for this year. Thank you for your ongoing support. If you do have any questions or want to talk about an individual portfolio or want to discuss anything further, then please don't hesitate to contact me or a member of the Luna team. Thank you very much. All the best.